Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Just wanted to quickly talk about this week. Thursday, we have CPI, Consumer Price Index. So that report's going to be very, very important. What we saw recently on Friday, we saw the equity markets and the bond markets basically rally on the worse than expected data points that came out, basically suggesting recession, but the equity markets were rallying just in the thought that the Fed would either pause or some sort of pivot would basically come into the equity markets. Now, very important to watch out and measure these levels, and important to also track how equities are doing. Important to notice that that move was very much an emotional and aggressive move, and if this week we get any signs of higher inflation, especially in the CPI report, we could very, very quickly reverse that Friday's move. And now, if you look at the bond market today is already, especially more on the long end, which is more related to inflation, has already started to reverse most of Friday's move and almost close to P1. And again, just on the idea that who wants to be long heading into, especially when you got data and when you got CPI report coming up in 2 days. Now, the equity markets, we did see some nice rally on Monday, some a little bit selling, followed by another spike today. But we're seeing the bulls kind of slow down their momentum in terms of buying, and we're seeing some selling pressure, and more sellers coming to the market or profit taking happening, which caused some selling late on Monday, and which is also keeping the S&P, Nasdaq, as I speak right now, midday around 12 o'clock, keeping it also um, kind of consolidating, instead of making a drastic move either up or down. So we'll see if something changes later in today. But the key is looking out and watching about, and making sure that, this week, that whether inflation, the CPI report, is it going to come higher than expected, or is it going to come weaker than expected. Now, if the number comes in higher than expected, then definitely it is going to send shockwaves into the equity markets, and you can definitely see some selling pressure. Now, the question is how how strong the data is. I mean, if the data is in line, it may bring kind of confusion or maybe some selling, but probably a buyback later on an inline data, or maybe not. But if the number does come in higher, definitely it will create a jolt in the markets and you will see some selling. Now, it's very likely, in what markets are expecting, that CPI is likely to come in weaker than expected, and we might see a rally instead of a sell-off on Thursday. Now, if the number comes in weaker than expected, you could definitely see the highs that we made on Monday definitely break, and we move up higher to the longer time frame resistance, which would be the channel that is, if you pull up a chart on the S&P 500, the resistance level, the markets have been basically trading in a channel between one support and resistance level, and it's been bouncing around there. So definitely we could see some move closer or maybe touching that level. And then after that CPI report, we're going to get also earnings. Earnings are going to start off, and what's going to be the kicker starting Friday? You got earnings coming from J.P. Morgan, Bank of America, Wells Fargo, BlackRock, Citigroup. We've heard already from BlackRock and Blackstone a lot of withdrawal issues um, with some of their real estate funds. So, you know, and many of them foresee 2023, the outlook not looking good, and especially recession coming in sooner than later, especially in 2023. So you'll probably hear the same rhetoric from some of these banks. Now, what would be a surprise is is something worse than expected, something worse than maybe a soft landing that maybe some of these banks are predicting. And also, what would be bad is if earnings or future outlook of earnings come in way weaker than what the analysts are expecting and what the markets are expecting. So very important to watch out for that, for the banks which are starting off the earnings on Friday. And very important to watch out for that as we head into the earnings seasons to see, you know, what's the theme for a lot of these companies. Now, it is expected that they are going to post some negative earnings report. So if that's already expected, it's priced in, markets may not react so significantly to the news, unless it is very, very far out of line than the expectation, right? And if the number does come in line or greater, then for sure you're going to see squeezes. You're going to see kind of this hopium in the market. We're going to see kind of this market rally, a relief rally in the markets for some of these names, pushing some of these indices higher. But then if you do, again, get worse than expected, then you can expect more downward pressure for a lot of these names and for the indices as well. And then after that, as we approach, I know it's a little bit too early to be saying this right now, but it is the second week of January. But as we approach and we get more data, more communication from the Fed, what we want to hear next is the Fed meeting in February. So that will be very, very key, and we will probably get an idea of what they may say after the CPI report on Thursday. Again, lots can change if we get new information in the next 2 to 3 weeks. But if we don't, then we can get a somewhat of an idea, especially with earnings, of where the Fed is leaning towards, if they are going to pause what people are thinking, if we're going to see some sort of rate a continuation of rate hikes, which is very, very likely and is expected, as we heard from the Fed. But again, what's very interesting to note is how different the bond market and the equity markets are trading, right? Off of just any news they can find that can create a relief rally, the equity markets are moving up. Yet the bond market is watching this data by data, play by play, trying to figure out that, okay, when is it's not a question of if it's going to happen, if there's going to be a recession. It's a matter of when is the recession going to come and how hard is it going to be. And when we get more confirmation from the data and from earnings and from these job losses that we're hearing about, then we can for sure see a very big move in the bond market, and which may temporarily, the stock market may also move in the same direction in the bond market, but then I think that would be a temporary move, and then there would be a decoupling where the bond market would continue to move up and the stock market would start to sell off on the unexpected, the kind of rude awakening that the markets have now finally realized that, hey, this recession is not going to be a soft landing. It is worse than expected. Now, of course, if it is shows any signs of soft landing and looks like the economy can continue to take in the rate hikes, and we do get inflation lower, then that's a totally different ball game. That's a totally different strategy. But right now, it looks like we're headed down the path of a hard landing, and it looks like that, sure, equities can move up temporarily, like we've seen many times last year. Every single time you get a weak data, you see this relief rally, and then after a couple of days or weeks later, we get that sell-off because we realize that the Fed is still going to continue on course, which is not good for businesses and the economy as a whole. So anyways, let me know what you guys think. Leave a comment below. Hit the subscribe button, the like button, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers.